Hello everyone. Welcome to my YouTube channel Financial Markets by CA Sandip Agarwal. So I'm recording a video after a interval of almost 2 months. So this is the third video under the options advanced, and in totality this is the 15th video under the total option series. So we have already recorded 4 videos each under options basic, options intermediate part 1 and options intermediate part 2. And we have already recorded total 2 number of videos under options advanced. This is the third video. After this, we will record the final and the fourth video under the options advanced, which will complete this video series on the options learning. So under this video, we will cover a very important aspect of the options, which is the open interest. So let's start. So this is the theoretical definition of open interest. So open interest indicates the total number of option contracts that are currently out there. So basically means whenever a person is buying a particular strike price option of any underlying instrument, so at the same point of time another person is selling the same contract. So it means the total open interest on account of this transaction between the person buying an option and the person selling an option is 1. Now, this open interest remains outstanding till the time that contract doesn't get squared off either by settling the difference in the price in cash between the buyer and the seller, or by taking or giving the delivery of the shares in view of that option contract. So this is bit theoretical. So in the next slide, I will try to explain the concept of the open interest with the help of an example. Now, in this example, let's assume, before I start explaining this slide, so in this entire video, whenever I am using any strike price or any open interest concept, I am speaking it with respect to the underlying instrument Nifty only. Now, let's start. So see, like say on 19th April 2022, a person A buys 2 contracts and person B sells a 2 contracts of Nifty 17,500 strike price call option. Now, in this case, the open interest will be 2. Why? Because person A has bought 2 contracts and person B has sold 2 contracts of the same strike price of the underlying instrument of the same expiry of the call option. And the volume will also be 2 because total 2 number of contracts has been traded between Mr. A and Mr. B. Now say on 20th April 2022, another person C buys 10 contracts and person C sells 10 contracts of the same strike price 17,500 of the Nifty underlying call option. Now in this case, the total open interest will become 2 plus 10, which is 12. Why 12? Because the earlier 2 contracts which were traded between Mr. A and Mr. B are still outstanding and they have not settled this contract either by way of the liquidation or by way of taking delivery of the underlying instrument in this case. So in this case, the total open interest outstanding becomes 2 plus another 10 contract which has been traded between Mr. C and Mr. D. And the volume for 20th of April will be 10. Why 10? Because only 10 number of contracts has been traded on 20th April. Now say on 21st of April, A sells 1 contract and B buys 1 contract of Nifty 17,500 strike price call option. Now in this case, you can see the open interest has been reduced by 1 quantity. Why 1 quantity? Because Mr. B had bought earlier 2 contracts on 19th April, out of which he has sold 1 contract. And similarly, Mr. D, who has sold 10 contracts on 20th April, he has bought 1 contract. So basically, they have squared off their existing contract obligations. So in this case, the open interest will be reducing by 1. That is 12 minus 1. becomes 11 and the volume will be 1. Why volume 1? Because only one number of contract has been traded between Mr. A and Mr. D on 21st of April, and we are assuming that there are no contract which has been traded apart from this. Now see again on 22nd of April, a new person, Mr. E, buys 10 contract and Mr. C sells 10 contract. So Mr. C has already bought 10 contract and till 21st of April, he has not squared off the 10 contract. Now on 22nd of April, C squares off his entire 10 number of contract and E buys those 10 contract. Now in this case, the open interest doesn't change at all because no new positions has been created. C has basically squared off his position which he has created on 20th April, and another person, new person, Mr. E, has bought those contract from him. So basically, the earlier contract which has happened between C and D, now in this case, basically C has exited the position and he has entered into it. So the open interest remains unchanged at 11. In this case, again, the volume will be 10. Why? Because only 10 number of contracts has been traded on 22nd of April. Now, before we move to the next slide, I just want to recollect a couple of things which we have discussed in the earlier video. If you recall, I have said that in any options, one person is buying the option and another person is selling the option. The person who is buying the option, he is basically paying the premium, and the person who is selling the option, he is basically receiving the premium. Also, if you recall, the person who buys the option contract, his net outflow from his pocket is only the amount of the premium which that person has paid and the other charges, and the person who is buying the contract is not required to keep any margin with the broker apart from the premium which he has already paid. Whereas in case the person who is selling a contract under the option, that person though receives the premium, but he has to keep an hefty margin with the broker in order to keep that contract outstanding. That margin ranges anywhere between 1 lakh to 3-4 lakh rupees, depending on the broker and the market situation. So whenever we are going to interpret the open interest, we will always interpret it from the perspective of the seller. Why seller? Because who is paying more money in the market in order to create the open interest position? The seller. Like say, if a contract of 17,500 strike price call option in our case is trading at say 50 rupees. Now one contract of Nifty 70,500 strike price is equal to 50 quantity. So 50 multiplied by 50 is 2,500. So the person who has bought 17,500 strike price call option, he has basically paid only 2,500 rupees. Whereas the person who has sold this contract, even though he has received only 2,500 rupees as the premium, but the margin which would be kept by that person with the broker would be around 1,50,000 rupees. So who is paying more money? The person who is selling the option contract. So whenever we are going to interpret the option chain, we will always interpret it from the perspective of the option seller, because the person who has got the more money is treated as more powerful in the market, and so that's why the open interest is always interpreted from the perspective of the option seller and not the option buyer. Now let's move to the next slide. Now in this slide, if you refer to this table, so just before I start explaining what is there in this table, so just let me give you a brief overview on this table. So this table I have basically taken a screenshot from a website called iCharts. So it's a paid website. You can also take the subscription to that website if you require. This is not a recommendation from my side to subscribe to this website. So in the middle where I have kept this pointer, this is the strike price of the underlying instrument Nifty. You can see the strike price, it starts from 15,700 and it ends at 16,700. And the middle strike price, which is entirely in the gray color, 16,200, this is the ATM, which is at the money. So the time when I have taken this screenshot, So at that point of time, Nifty was trading at around 16,200. So that's why this line is entirely in the gray color. Now, on the left hand side of this strike column, you can see the data points pertaining to the call option. And on the right hand side of this strike price column, you can see the data points for the put option chain. Now, let us see where is the maximum OI. OI basically stands for open interest. So where is the maximum OI or open interest stands for the call option for all the strike price. So we can see at 16,500, there is the maximum call open interest, which is around 60,000 quantity. So 60,000 quantity divided by 50 will be the number of the contracts which would be outstanding. So the 60,000 is basically in the gross number. If you want to compute the total number of option contract, then you have to divide this quantity by the number of quantity which is there in each contract of the underlying instrument. So in our case, the underlying instrument is Nifty. So in one contract of Nifty, the quantity is 50. So if you want to compute the total number of open interest, you can consider this amount divided by 50. But this is not required because the unit of measurement of 50 is uniform in all the cases of the call open interest as well as the put option open interest. So we can consider this quantity. Now we can see at 16,500 strike price, there is a maximum open interest on the call side, whereas similarly on the put option side, the maximum open interest is at 16,000 strike price. So it means that the maximum number of people are expecting the Nifty to not cross 16,500 in that particular expiry for which this data has been taken. Whereas similarly, the people in the market are not expecting the Nifty to break 16,000 level in that particular expiry for which this particular data is there. So how are we interpreting it? As I explained in my previous slide, that whenever we are going to see the open interest, we will always read it from the perspective of the option seller. Now, what is the maximum win situation for the option seller? The maximum win situation is the amount of the premium that has been received by the seller for that particular strike price. Now, what is the maximum profit for that person who has sold the option contract? The maximum profit is the amount of premium which has been received. Now, now we can see that the maximum open interest on the put option side is standing at 16,000 and the maximum open interest on the call option side is standing at 16,500. Now, in case the Nifty stays in the range of 16,000 to 16,500 till this expiry, so the entire amount of premium which has been received by the option seller for the 16,000 strike price of put and 16,500 strike price of call will be entirely pocketed by him. Now, on the day when I have taken this screenshot, you can see the premium of 16,000 put option strike price was 75 and the premium for 16,500 call option strike price is 46. Now, in case the Nifty stays in this range of 16,000 to 16,500 till the expiry, then this entire 75, which will be around 3,750, that is 75 multiplied by 50. So 3,750 amount of profit will be made by the person who has sold the 16,000 put option. So this 3,750 profit will be on per contract of the open interest. Whereas similarly, in case of 16,500 call option, the maximum profit would be 46 into 50, that is 2,300 on per open interest contract. Now, see if a person would have sold a strangle. So if you recall my earlier video, so a short strangle means a person selling an OTM call and the OTM put option. Now say if a person has sold both 16,000 strike price put option as well as 16,500 strike price call option. So in this case, the person would have received and amount of 75 plus 46, that is 121 rupees per set of short triangle, which is around 6050 rupees. So this is how we interpret the option chain. So this is one of the important aspect of considering while initiating any trade on the options buy side or on the options sell side or using any structure. So though this is not the only one way of initiating the option trade, there are various other ways also of looking at by which the person initiate the option trade, but this is also one of the way. So in the earlier videos, I have also explained the IV concept, the delta and the gamma concept. So this is also one of the concept. With the combination of all those concepts, the people can use it in their own way and decide whether they want to do the option selling or the option buying, and accordingly they can decide the strike price as well at which they want to sell the option or buy the option. So in this slide, we will basically discuss this core concept LV, SB, LU, SC. So on the right hand side, you can see LV stands for long builder, SB stands for a short builder, SC stands for short covering, and LU stands for a long unwinding. Now, how do we interpret it? Now, if the price of the underlying instrument, which is Nifty in our case, has gone up for a particular day, and at the same point of time, the open interest, the total open interest. So in the previous slide, I have shown the open interest on the option side. So apart from options, there is also a futures contract as well, which is traded. Now, this open interest, when I am saying, this is a combination of the options interest and the futures interest taken together. Now, at any point of time, there are 3 months of contracts which are there. So like say currently we are standing in the month of June. So if you go and browse the market on any market app or on the NSE website, you will see the option contracts on the Nifty instrument outstanding for the month of June, July and August. Once the June ends, then the contract for the September will get also opened. Now currently the contracts are there only for June, July and August. So when I am looking at the open interest in this table, it means this open interest is basically the open interest for the options as well as the futures for the June, July and August taken together. Now, if the price of the Nifty on a any particular day has gone up and at the same point of time the OI has also gone up, it means there is a long build-up in the market. It means this is a signal of a bullish position in the market. So it is not always necessary that this will be the case, but this is the obvious interpretation which happens in the market. Obviously, there are certain exceptions as well, but uh, uh, most likely it is interpreted in the market as the long build-up. So this is a sign of a bullish position where the price is also going up and the persons are also creating the positions. Second, when the price is going down in the market, but the open interest is going up, it means the price of the Nifty has fallen on a particular day, but the open interest has gone up. So it means there is a short buildup in the market. So this is an indication of a bearish market. So it means the people are expecting the market to go down. That's why the open interest has increased even though the price has gone down. Third, when the price of the underlying instrument, which is Nifty in our case, has gone up, but the open interest has gone down. So it means that the price is going up, but the open interest has been reducing. It means that the person who has earlier created the short positions, they are basically unwinding their position. It is traded in the market as short covering. Short covering means the persons who has basically built up the shorts earlier, now they are covering their shorts. So that's why it is called a short covering. Similarly, when the price is going down and the OI is also going down. So when the price is going down and the OI is going up, it's called a short buildup. Whereas when the price is going down and the OI is also going down, it means the long unwinding. So it means that the price is going down and the OI is also going down. So the long winding means the people who was earlier created the longs position, when the price was up, so they have basically unwound their position because now they are no longer bullish in the market. So this is just the interpretation of the open interest, considering the open interest on the option side plus the future side are taken cumulatively for the 3 months. So that's it from my side under this video. In the fourth and the final video, I will give you a couple of examples on the basis of which you can take a decision whether you should buy, uh, you should do option buying or you should do option selling. So I will cover only one or two examples in the next video, which will give you a brief idea. There are many other ways where a person can decide whether he want to do the option selling or option buying, or he can do various structures as well. In the next video, I will show you a practical example that how you can decide whether you want to do the option buying or the option selling. So that's it from my side. I hope you have liked the content in this video. In case you are liking my video, please do like and subscribe to my channel so that you can get notifications for any future videos which would be uploaded in the future. Also, in case you feel that my videos are adding value to you, so please do share my videos with your friends and family so that it adds value to me as well. Thank you.